Hey, what's up, everybody? Welcome to Built to Scale. This is the segment where we cut through the BS and actually talk about what it takes to scale a business. Today, we're talking about one of the biggest lies in entrepreneurship. Just because your revenue is growing doesn't mean your business is financially healthy. Joining me today is Larry Rice. Larry's a CPA, a CEPA, and founder of RVG Company. He's helped countless business owners find the financial blind spots that quietly kill your business before becoming a disaster. Larry, welcome to the show.
Thanks for having me, Matt. Really looking forward to this.
Awesome. Hey, Larry, I want to talk about some things. I really want to get down to it. I want to talk about the stuff that business owners they don't see coming. Everybody wants to scale, everybody wants to grow, but sometimes the numbers, they're telling a different story before the owner even realizes it. So today we're going to break down the 5 financial blind spots that stop business owners from scaling. Larry, thank you for joining me, man. I'm excited to get in here and talk to you today. And I really want to talk about revenue versus actual financial health. A lot of business owners out there, they brag about revenue. They're doing 7 figures. They're doing 8 figures. They're busier than they've ever been before. But sometimes the business, isn't growing. The revenue's going higher and they're still bleeding from underneath. What do business owners really often misunderstand about revenue versus actual financial health?
Well, I think what business owners miss about revenue and financial health is the old saying, revenue is for the golf course and profits or for the boardroom, right? The goal is to put as much to the bottom line. The top line is very sexy. It sounds good. It sounds wonderful to brag to people about how much money your business can bring in. But the reality is if you don't take it home, what's the value in that?
Oh, listen, I couldn't agree more. You go on the internet these days and you see every e-com guru out there saying that they made $100 million. Is that revenue? Is it profit? No, but when you look under the hood and you find out that their profit margins are 0.0002%, it's like, why did you even wake up and get out of bed in the morning?
Yep. Well, I could even take it a step further, Matt. I mean, when you start talking about revenue and then you're not thinking about profit, but that means you're probably also not thinking about cash flow because you're in the banking industry, you've loaned people money and help people generate capital for the business. You think about when a business has actually got good profit and then they're not cash flowing and they can't even support the operation of business and they certainly can't grow because they don't have enough cash flow. Paper profits are great, but if you don't have the cash flow to run the business and to continue to grow, that's also a big problem for you.
Yeah, absolutely. Scaling is also about controlling the momentum because if you're taking on jobs, if you're in the contracting space or you're getting paid on terms net 30, net 60, net 90, and you don't have the money coming in to support the extra work, you're going to put yourself out of business real quick. But my question for you is this, can growth actually make a financial decision worse, a bad financial decision worse?
I think it can. I mean, I'll give you an example. I work with a lot of contractors, general contractors, specialty contractors. I have a great example. Had a very young specialty contract firm come to me, wanted to go buy it. One of its competitors got the things that was missing: great sales, great backlog, and some really good technical people on board. But the reality of the question was, well, how are we going to fund that? And also, why do they need to be purchased? Why are they being acquired? Because it was also another young guy that owned the business. And when it really came down to it, they were in the other business was on the edge of financial ruin, right? The owner was great at technical side of it. And he was good at sales, but he didn't know how to cash flow that business. He didn't know how to keep it moving, right? So this decision could have been tremendously dangerous for my client going out and buying this business because he's not thinking about the cash flows and stuff. He's just looking at the opportunity. But the reality is you're bringing on a lot more staff, a lot more opportunity, of course, but how are you going to fund it? How are you going to move that growth forward, right? And this is a different type of growth, right? We're not doing some type of natural growth cycle. We're actually making an acquisition to do it. The other side of that was, hey, why don't we just hang out and wait and see and keep in contact with these guys and let's watch them just go further off the cliff because we could probably get a great discount, gives us more time to establish a good capital program to get out there to make a
Mhm.
good acquisition at a very valuable price. And that's exactly what happened. We waited 3 months. They couldn't make payroll. We were able to come in pennies on the dollar. We also knew that this was a possibility, so we had spent 3 months getting together and putting together a capital structure that allowed us to make a good business decision. Had we done it prematurely 90 days before, I question whether we would have survived it.
Well, listen, I tell you this, when you're scrambling, it's never the right time to make any type of decision,
Right.
whether it's to buy a new business, sell your business, or grow. Because guess what? If it's the right deal, it'll still be there later on.
That's right.
As entrepreneurs, I do it myself. We all tend to get so excited. We get shiny objects. It's going to be there. It's a limited time. We buy our own bullshit sometimes that we sell to ourselves. It's really what it comes down to.
Yep.
Let me ask you this. Everybody knows top line sales, revenue. What are the 3 numbers that every business owner needs to be aware of?
Well, listen, I mean, gross profit first and foremost. Are we making money
Mhm.
from what our actual business is doing? We need to be on top of that. We need to make sure that our margins are in line with what we're trying to accomplish. I mean, are our margins supporting growth? Are our margins, are they too low? I mean, there's all kinds of angles you can look at it from that. The other thing that I like to look at is operating cash. Is the operations of the business generating cash? When pull out that cash flow statement, look at the operating cash. If we don't have positive cash flow coming from there, we better have a good explanation and a really quick understanding of how we're funding that, what that looks like, how are we going to do that? Because to me, what is a business? It's its ability to generate cash, specifically from operations, right? And then, I mean, you get very industry specific. There are a lot of different numbers we could be looking at. But I like to pay attention to working capital very closely. I really like to stay on track with following cash flow, right? 13-week cash flow projection. I know that's a little beyond the numbers you're asking for, but I mean, you have to be paying attention to that cash flow. One of the scarcest resources in any small business is cash. And it's the lifeblood of those organizations. So anything to do with cash, I have an eye on it.
I'm with you. It's the fuel to the engine, right? If we have a great engine that goes 0 to 60 in 2.6 seconds, but we can't afford the gasoline inside of it, what good is it?
That's
Right?
right.
Larry, another big pet peeve, and it's a huge blunder that I see people make, is they tend to keep their CPA in their cell phone, but they treat it like an emergency contact number. They call once a year. They want to dump everything on you all at once, and they hope the damage isn't so bad. This is a huge mistake. Tell everybody about why waiting until tax time to find out how the company did is really a bad business move.
Uh, it's a tremendously bad business move. And I have to tell you, after running my business, the CPA firm, for the past 14 years, um, I would tell you it's the CPA's fault. Why is your CPA not in front of you? Why is he not being proactive to get out in front of you? Because it is a massive mistake to talk to this person who has so much knowledge about industry, tax law, accounting, the different sectors that could potentially affect them, and really be somebody who could be deeply involved with your business and help you to understand things that you can't, to truly understand your business and to truly understand aspects of your business that maybe you're not paying attention to. One of the things I love to tell my business clients is you get to see the inside of your business every day. I get to see the inside of hundreds of businesses every year. So while you may think that you have all the answers for your business and everything, I promise you, if it's not me, your CPA has a tremendous amount of value to share with you, be it on tax or on business strategy or just accounting strategy.
Yeah, 100%, especially when you're going through issues, right? You're so stuck looking at the tree, you're not seeing the forest from above. You know, it really comes down to, I think, when I speak to business owners all the time, hey, when do you talk to your accountant? When I got to file my taxes? That's not good. You should be planning your taxes all year long. In my opinion, basically, you should be speaking to your CPA at least once a month, if not every 2 weeks, and letting them know everything that's going on in your life, because it could dramatically change your tax bill at the end of the year.
That's correct. You should have a very steady cadence with your CPA. Maybe every month is a little bit more than I would recommend, but it depends on the business. It depends on what you're doing, right? I mean, if you have multiple operating businesses and and you've got complex transactions or things like that you're planning or taking on, every month's probably a great plan. But if you've got something that's more steady, more consistent, one business, even a quarterly cadence is probably the right way to go. Um, Meeting with somebody annually doesn't allow for preventing these kind of errors, these kind of mistakes, these missed opportunities, if you will. And I mean, there are a ton of opportunities out there. I look at tax planning, it's a lifelong, it's a lifelong game. Every time you enter any kind of transaction, buy a piece of real estate, buy a business, any of those kind of things, it's kind of like getting married. Like, what is your prenuptial? Like, what is your exit look like if you had to exit this? And of course, nobody gets married with the thought, hey, we're going to get divorced. But let me tell you, a lot of my clients, successful business clients, they want to have that agreement in place before they get married. But then we go into business and we don't even have a thought process of where this road's going to take us. We're just
Yeah.
making an investment in something. And listen, some of these investments are run by good funds or good business operators, and they're saying, hey, this is a 5-year game or a 6-year game. Well, that's great. That's easy for us to plan for. Hey, we're going to have a capital gain. We estimate it to be this in 6 years. It's on the board. How do we start planning for that? How do we manage to reduce that tax 5-6 years out from now? Other opportunities, other things that are potentially coming in the next 5 or 6 years, compared to never meeting with a CPA, not discussing those things. And I can't tell you how many times we meet with people that we literally have meetings with them, and then you have to pull the information out of them. They don't want to share the information. It's so important to just be open and to share, because that gives us that opportunity again to take that lifelong planning, look at it. How's this all going to play out?
I think you're right. And I think you actually hit on something before that's really powerful and we should really break down for everybody that's listening. There's levels to this game, folks. There's levels. My accountant handles that. I hear that all the time. No, my accountant, or when you speak to your accountant, once a year. Okay, what does your accountant do? He does my taxes. There's levels to the game. There's a difference between an accountant, an enrolled agent, a CPA, a CFO, your bookkeeper, right, and a controller. Can you run down basically where or what every business owner should have in place, right?
Oh,
And let's go a million, from a million to 5 million to 10 million in revenue, where they should be.
all right. Well, I'll try to put that all together for you. The idea is, in the business, I mean, at a minimum, especially at $1 million, you should at least have a bookkeeper inside the business. I personally don't think that that's enough. I think that you should be looking for a controller level skill set. And let's talk about that. What is a controller level skill set? It's somebody that has a very strong understanding of financial reporting, probably has very good understanding of generally accepted accounting principles, somebody who can reconcile the balance sheet, understands the difference between cash and accrual accounting, and can literally sit with you, close the books every month with little to no error, and be able to present that to you so that you can at least understand those financial statements. And I honestly, I think around $1 million business that you could probably survive with that and interacting with your CPA in a strategic manner. Operating with them, having a cadence, monthly or quarterly cadence where you're discussing what they're seeing in those financial statements, right? You start pushing up to 5 million, getting to 10 million. We got to start talking about having potentially a fractional CFO or a full-time CFO on the team. Depends where you're taking the business. Where are you going, right? I always take that answer. It depends, but it kind of depends on where you're going with the business, right? And
Mhm.
it also comes down to what is the technical or accounting skill of the actual owner themselves, and how much time do they want to spend doing it, right? Because you have some people that are very good at accounting, understand finance, and are really good. They could probably live with a fractional CFO and have really, really good conversations and get it done. And then you have some business owners who, that stuff is crazy. I didn't like it in college. I don't want to learn about it now. I certainly don't want to talk about it. I just want you to tell me what to do. You're going to need more hand holding. You're going to need something that allows you to really dig in your business, get some strategy, get some ideas, really understand how the implications for tax, for business, lending, raising capital, selling the business, all of these things should be constantly on your mind. I just wrote a piece recently about when's the right time to plan for your exit. And I think that was similar to the event we met at, Matt, was a kind of a
Yeah,
conversation about that. What's the timing? The timing is now. The timing was yesterday, right?
correct.
We all plan like it's going to be a transaction that we control. But my piece was, when is it out of your control? When do you not get to make the choice? When is it an illness or a family illness or something that's going to take you away from the business? And if you don't have that expertise in your team and you're not planning for it and you're not talking about it, then that becomes a real problem. That's why I think when you start getting past $1 million, you've got to start making that investment in a fractional CFO or a full-time CFO on your team that can really guide you through your finances, can really even help work with your tax accountant to make sure that they know all the pieces and they know what's important, they're getting it done.
Yeah, I totally agree with that. I couldn't have said it better myself. Unfortunately, we're in this reality. It's like people just wait way too long. Business is going good. All they can think about is this topic. How do I scale more? How do I scale more? Then they get hit with something that knocks them on their ass. One of the D's: death, divorce, disability. And then guess what? They're scrambling because maybe they can't run the company anymore. Maybe they got to take some time off. Maybe they're screwed. And if they would have just practiced what we're telling them right now and done everything right along the way, they could have actually had a fighting shot of selling their business and not just been another statistic of an 80% of businesses don't sell that get listed, right?
Yep.
So it's
Yep.
really important that people do this, and unfortunately, look, until the doctor tells us we have type 2 diabetes, we don't go on a diet, right? It's a terrible thing, but we actually have to, again, like you said, we have to get more proactive rather than be reactive to things. And
Yep.
it's not just accountants, a lot of accountants that are reactive, it's business owners themselves.
Yep.
One thing that we see all the time and people call us all the time is because they got cash flow surprises going on, right? This is the thing that sneaks up on people. They're closing deals, their timings off a little bit, they're hiring, they're adding overhead, right? They're buying equipment, they're taking on bigger projects, and somehow they're asking, hey, where did all the money go at the end, right? And if they're getting paid on terms, that money's not coming in. So they call us up and say, hey, Matt, I need some money. Okay. When I talked to you 3 weeks ago, how come you didn't tell me that this was all coming up and we could have put a proper credit line in place? Because one thing that I tell people is fast money is not cheap and cheap money is not fast. Again, if you're scrambling at the last minute for everything, it's never going to work out in your favor. Why do business owners tend to get fooled? Because I know a lot of them, right? And the way they judge the health of their business is every morning they look at their bank balance, right? How come that fools people?
Well, I mean, it really comes down to bad information. What is a bank balance? I mean, it's in the rearview mirror, and in isolation, it's a number, right? I don't know what's going to get deposited today. I don't know what's going to. I mean, I have an idea what checks I wrote. I maybe have an idea of what might come in, but I don't really understand how that transaction is going to work, how this is going to flow in. We always recommend, one, if you're doing a transaction, the first thing we have to talk about doing is pro forma financial statements. And this is where you start talking, going back to your last question, which is, should I have a controller, a bookkeeper, a CFO? Like what kind of expert help do I need? The reality is, and I'm not saying all bookkeepers, but most bookkeepers aren't going to be able to handle that. And I'll tell you that a lot of controllers won't be able to handle that. You need somebody with experience that understands financial reporting, understands how transaction flow works. How's that cash going to come in? What are the notes that I'm carrying? What is the deferral of time? And by the way, deferral of time collecting that money can be very beneficial from a tax perspective. Still got to understand how that money is coming in. So when you do a set of pro forma financial statements, I look forward 12 months, 18 months, you can project out 5 years showing how when that cash is going to come in. You and I both know a 5-year projection is not worth much, but to understand where the cash from that deal is going to come into the business, very important. Take that and put it into a 13-week cash flow projection. And now I can see an entire quarter, a rolling quarter out in front of me. I can see, hey, I have a rule. My rule is I got to have 60 days of cash in the business. I can see what that 13-week cash flow, what that dip in that 60-day cash is for me. I know where it's at. I can see it coming. I can prepare for that, right? And so if I can see that 45 days out, I can call Matt, I got a dip in 45 days and I don't know how I'm going to fund it. The other thing is I can also change my management style. Hey, I know I need to get some money and maybe I'm going to incentivize a different client, a bigger client to get some cash into the business faster, get him to pay faster by maybe giving him a discount or some type of deal, or I got to raise volume.
You know, that is one of the biggest things that I tell clients right away. Hey, call up your client that's 90 days out. Tell them you'll give him a 3% discount if he pays today. And they don't take advantage of it. They're afraid they're going to lose the client if they do that. They're afraid they're showing fear, right?
Yeah,
It's just that fear that they need to get over because the client would gladly take a 3% discount or a 5% discount, right, to pay up front
yeah, of
today. I would do it if somebody called me. But if you're going to give me
course.
if you're going to allow me to have those terms, I'm going to take every last day. Just the way the world works.
Of course. Why wouldn't you? So I teach a session to some entrepreneurs. I do it twice a year, and we talk about the cash cycle. You know, how long it takes for money to come out of the business and how long it takes to come back into the business. And then we talk about every position around that cycle and discounts. It's amazing to me to see the response around the room. Most people don't want to give a discount. Most people don't even want to have that discussion, but yet they'll pay the merchant banker fee to get the credit
Yeah,
card to come in, right? And it's like, well, maybe we should be talking about charging the customer that. And we're seeing a lot more of that, by the way, in the market, right? A lot more businesses that we traditionally didn't see doing that are doing it, but there's still an opportunity to speed up that cycle. And we shouldn't be afraid of discounts, and we shouldn't be afraid to strategize what those opportunities are to shorten that cycle to get money back into the business.
absolutely. Listen, I go as far as when I have a company that comes in and they have a lot of receivables that are due. So we look at some AR financing for them, right? I show them how factoring those receivables will actually make them money, right? Rather than costing them money. And a lot of pushback that I get about factoring receivables is the same exact thing. They don't want to ask their clients for a discount. They don't want to ask their clients to sign the paper to allow them to factor, right? They think they're the only people in the world that have cash flow cycle issues, right? If their
Right.
client's a lot bigger than you, there's a chances are they factor already. I hate to
Yeah.
break the news to you. The number one factor in the world is Hewlett Packard, right? So people just got to stop being afraid to ask, number one, because it could substantially change their cash flow inside the business. And you brought something else up that was really good, structure, because I want to talk about structure and specifically a couple things prior to selling about how your structure should be looked at. But, I know over here, every time I speak to somebody, their file comes in, they're still a sole prop or they're an LLC. They never converted. They never even get taxed as an S corp. And I ask, why do you still have this entity structure? And they say, hey, Matt, it was just the way it was on day one, and I never changed it. I've had people come in to me that are no longer in real estate. They're running a manufacturing company, but the NAICS number, right, is still in real estate. So they're getting red flagged by banks right off the ground. How can the wrong entity, tax or financial structure, create problems that you see later on for a business?
I mean, there's a lot of different ways that an entity structure can definitely cause a business problems in the future. But when you start looking at the LLCs, the sole props, and things like that, you really start to see the problems with the tax structure, especially as the business grows and how the people have been doing the tax returns and preparing that. I mean, just simply, if I'm going to sell my business and I'm a sole prop, the fact that my business is running through a Schedule C, now I've got to give the buyer potentially my personal tax return so that
Mm-hmm.
they can see what that looks like. They have a bigger, better understanding of who I am as an individual, more so than they probably need to know, especially during negotiation or due diligence phase of a deal. Um, I look at the F corps and it's like I think that a lot of people immediately think, hey, let's transition everybody into an S corp. The second that they've got a successful business or getting off the ground, I hear a lot of tax professionals, hey, straight to an S corp. Sure, it's an easy thing, right? Let's get rid of that. Let's minimize the employment tax um, to the owner, and let's use that as part of our tax planning tools instead of rather looking at more what are the other options? What are the other alternatives? We also look at real estate, having real estate or any other kind of appreciating asset sitting inside of an S corp. Well, if you're going to own that long term, we're going to have some issues if we try to do some estate and trust planning down the road. We could trigger some capital gains that you have to
Mm-hmm.
pay before you've sold the property, and that just doesn't make sense to me. So why would we do that? Um, I mean, listen, we could go through dozens of reasons. The other thing I would think about is tech companies or, the kind of companies that qualify for qualified small business stock, Section
Oh,
1202
you,
of the
you stole
code.
my thunder. I wanted to go there. That's
Oh,
my favorite one. That's my
Matt, and
favorite one.
I knew you were going to go there. Everybody loves this stuff. 1202 is the best, right?
Yeah,
So,
so let's back up. Why don't you tell
yep.
the audience exactly what
Mhm.
QSBS is and why it's my favorite?
Well, qualified small business stock, I mean, in a big picture, is a real opportunity that exists in the tax code for, and it's not good for every business. Let's just start there. There's a lot of businesses that are self-reputation or medically driven or things like that that are not qualified for this. But take a tech company, somebody that's developing a piece of software or something like that. You could have a real opportunity to sell this business with a pretty sizable gain on it because tech companies tend to build valuation very quickly, especially as they put on customers. There's a real opportunity to significantly or materially reduce capital gain um, on that transaction. Upward of $50 million gets taken out of the gain. So,
Wait, wait, wait,
and
wait, wait.
again,
Slow down. Back it up. We can't just skirt over that issue. Can you say that number one more time so everybody can hear that?
I'm gonna look it up right now, Matt, just to make sure, right? Because things change. So let's just double check it. Lifetime exclusion limit is greater of 15 million or 10 times your cost basis, right?
So that's $50
And
million tax free, folks.
yep, must be a domestic C corp. The company's aggregate gross assets must not exceed 75 million at the time the stock issues. Holding period, and this becomes the big thing, right? The holding period of 3 to 5 years. 3 years doesn't get you the full deduction, the full benefit of the stock. And I don't want to
Mhm.
get into depth on this and try
Yeah.
to get into details and have you guys out running around, took my tax advice, and now you're also calling your lawyers to come after me. This is a real opportunity that exists in the tax code. It is very, very specific. It is very technical, but it is a real benefit. And this is where you need a good tax professional, somebody who can sit down, walk through your business, and set you up for this properly, right? A good attorney on your team that can help make sure that you're established and set for this. The other side of it is you have to be a C Corp, and you have to be a C Corp for a period of time to take advantage of that. That means you're subject to double taxation as you're building for that. So as much as that's a big benefit on the back end, you've got to do some analysis and say, what is my income going to look like as I build to this? And what is the evaluation here? And again, we're projecting, we're looking at, hey, here's what the maximum benefit is, and here's what that extra tax or double taxation may cost you down the road getting there, right? So it's not all about figuring this out. You know what I mean? It's not all about just, hey, jump in QSBS. No tax strategy is. It's all about knowing the numbers, laying it out, doing an analysis, and hopefully taking advantage of that.
Yeah, I love that strategy. But again, there's a lot of fine print in that strategy. So get with somebody that actually knows the ins and outs of it. Larry does, his team does, and then a tax attorney also. You should always have him on your team for that as well. You know, Larry, let's move on to, we're talking a lot about scaling, and me and you, we really work on the exit side. I'm gonna have you back on and we'll have to talk about that. But for right now, funding, exits, major growth readiness, right? What should companies have buttoned up before they're seeking funding? I mean, I can chime in on this one a little bit. I may know a thing or two about that. Preparing for an exit or making another major growth move. What are some things they should really have buttoned up prior?
Well, we talked about this a little bit earlier about when's the right time to plan for that exit. And we said now or even yesterday,
Yeah.
right? It's everything, right? The better prepared your business is, the better, the easier this exit will be, the better. And I think overall, it's not about how easy exiting the business is, right? It is, I want to optimize the value of my business. I want to be the best in space, best in industry, best in class business when I go to sell my business. I want the buyer to want to use my business as a platform, hopefully, not as a tuck into their business. I want them to see it as a platform, right? I want to have great policies and procedures in place. I certainly want to have great financial records in place. I want to be able to demonstrate to a buyer that we have our together. We have it together and we are buttoned up. We look great. We're well thought out, and we're as close to perfect as perfect could be. I think that's the best way to look at it. And you
Hmm.
know, I think when you do all of those things, you run a more efficient business, you run a more profitable business. The KPIs, the thing that your industry looks at you for, are going to those financial ratios, those things, they're going to look good. They're going to be best of class. And those, when you compare them to a benchmarking, right? And I think getting ready for a sale, those are the things we really want to look at. In my opinion, at least, we want to be really focused on: are my contracts good? Those policies and procedures, and are my financial records ready to go? Do I have key people locked up? Or are they going to run the second they hear there's a sale coming? Those are my
Yeah,
thoughts.
listen, I couldn't agree more. You got to be buttoned up along the way, right? When it comes to funding on my end, a lot of people call me up and say, "Hey, I need money. I got an acquisition. I want to buy another company. I have an opportunity to buy some more inventory." And then when I ask them for clean financials, believe it or not, I'll get people who have told me they haven't done their taxes in 4 years, right? We'll get people that say, "Oh, yeah, I got to get that from my accountant," and never gets it back to us, right? That's why I like working with Larry and other people inside of our CEPA community, because somebody comes to me, if they're my client and Larry's client, what's going to wind up happening is, "Hey, Matt, I need this money. I have this opportunity." Okay, cool. I can get you the money. Can we pay for it? Let's get Larry on the horn. Larry, here, the money's going to be a little bit expensive, but can we make this happen? Right? And then we all make an educated decision together. There is no one person for everything, right? It takes a team. We hear the saying, it takes a village. It takes a team to run, raise, grow, and exit a company, right? And the more players that you have on that team that align with each other, right? It's only going to make your business more valuable at the end. But again, we can only do so much. We can give you recommendations. We can tell you what to do, but you got to put in the legwork and execute.
Couldn't have said it better.
You know, how far in advance, and I get this from we me and you both say as soon as possible, right? Start today. You want to start? I don't want to sell my business. Who cares? Let's start getting everything ready to sell today. Because if that opportunity arises, it's there. What's the shortest time frame that you think somebody should start preparing for succession of a business? In your opinion, like what is the shortest amount of time? Is it 18 months? Is it 24 months? Right? What would you think?
I mean,
So we don't have a fire
with
sale.
with the right team, and I mean the right team, and a lot of ability to really put your mind to it. Uh, Man, I would guess we could do it in a year. I mean, like really dig it in and a really, really strong team. I think you could do it, but I still think you're going to be leaving money on the table a year. The more time we have, even if it's not perfect, if you had 2 or 3 years, at least the tax strategies we're getting into place and we're laying out how we're setting this thing up. 1 year, we can get the policies and procedures, we can get employees locked up, we can, optimize pricing and stuff. But the 1 year, you can't show the history of it. I'll give you an example. We have an ALF deal that we're working on up in Central Florida. It's improving. Things look great on paper, but the business has been off, and it's not for the lack of effort from the owner. It's just some industry conditions, some economic conditions, right, and then some
Well,
bad.
that's actually an important point that I think goes along with our thesis, right? If you're not planning to sell, it doesn't mean it's not the right time to sell, right? Sometimes we got to look at market conditions and decide, and we want to be sellable at the time the peak hits. Even if we don't
Yeah.
plan on it, we may get an offer, right? And we need to be ready to capitalize on that offer.
Well,
So,
that goes back to everything's for sale for the right number, right?
yeah.
I mean, I don't plan on selling it, but if somebody shows up and makes an offer that's out of this world, great. And
Mhm.
I've seen that happen where somebody shows up and they're like, "Hey, I didn't have any idea my business would be worth this. They just offered me a lot of money. I think I want to look at this." But by the end, after we got through due diligence, because they weren't ready for that sale and they weren't optimized, and there was a lot of things that were kind of messy in there. There were some price reductions. There were some things that we had to give into. Maybe the deal wasn't as good as we originally first thought it was. Still turned out to be a very good deal for the owners. But it's just to show you that just because this is the offer that comes in doesn't mean it's going to stay there if the business isn't what the buyer thought it was going to be when they got under the hood. Does that make sense?
Yeah, absolutely. Hey, Larry, thank you so much for joining me. I want to be respectful of your time. Can you tell everybody where they could find you, whether it's LinkedIn or how they can reach out to RVG and Company?
Yeah, you can always reach out to me at RVG and Company. It's lrice at rvgco.com or 954-233-1767. I'm a managing partner there. We got a great team of tax advisors and fractional CFO style business that we do. We're always here to support business owners.
Larry, thank you so much, man. I really do appreciate this. I know not everybody listening is into tax as much as I am. I'm like one of those weird guys. Like I like obscure tax laws and figuring out ways. And then I call people like Larry and he tells me you're crazy. It's never going to pass and hangs up. But you need those in your life. But anyway, yeah, I love QSBS, cost segregation. You know, these are things that you don't know what you don't know. I had a very big meeting the other night and we were just with some very high level people. And if somebody didn't introduce us to some of these strategies, we would never believe them, right? So strategy, execution, and being proactive are keys. But Larry, let me ask you one question before I let you run. What's one of the biggest pet peeves in your industry that you can't stand?
Well, I love hearing from a business owner that says, "Well, my next door neighbor did this or got this," and I say, "Well, did you see it? Did you actually see that? I mean, did they just tell you that while they're having a beer with you in your backyard, waiting for you to finish making those ribs?" And they're like, "No." I was like, "Okay," because maybe they did, and maybe their accountant is, got some magic wand and he made something creative happen. And the thing I think is the pet peeve is that people misunderstand and then they tell it to people differently. And by the time it gets back around to me, it's, you need to wave this magic wand and make this capital gain completely disappear. When the reality is without planning, without proper, establishing yourself and setting yourself up, the likelihood of that is not great, right?
Yeah, but
Uh,
the problem is, Larry, that wasn't his neighbor that told him that. That was TikTok these days.
Now that could be my new pet peeve, but I was going to stay away from the social media influencers because I had one of those moments last night from a client who said, "Hey, I saw this," and I was like, "Well, sure, you can do that, but we're probably not going to do that together because that's not legal." That happens. I see that quite a bit, and there's a whole thing about it now. We're seeing that amongst some tax attorneys and some other CPAs and stuff that are starting to get together and starting to kind of push back on that moment. And that's something I'm looking forward to doing here in the future is kind of, starting to talk to those points like, hey, we can't, you can't promise something like that because it's probably not legal, or you got to be careful what you're looking at, right? And that's what I'm really afraid of is social media becoming, how do I put this nicely? You drive down the road and you see all these tax prep shops along the road that aren't
Yes.
CPAs, they're not EAs, they're fly by night, they're gone, and so many people are taking advantage of it. And not all of them are that way, by the way. I want to be clear, but this is a real problem where people are getting their tax returns done at places like this. And is social media kind of setting us up now for some of that? And I'm not saying all these influencers are bad because there's a lot of really good ones out there that are really legitimate, but there's some that are out there that just seem like they're just trying to take advantage. And are they that fly by night type of shop? Are they going to be there with you when the hammer comes down? And defensible positions, right? That's what the game's got to be about. Because if you're not in a defensible position, you're likely going to lose, and the penalties and interest and the tax are going to come back to get you. And that's just not where any of us want to be. And I certainly don't want my clients to be there.
No, I totally agree. Listen, we see it in my industry too, all the time. Go, I can get you 200, go file an LLC today. I'll get you 250,000 and 0% interest, blah, blah,
Oh, I see
blah.
it
Then
all
you
the
can go
time.
out and buy a car and now you have an asset. You put it on Toro and you can make $300 a month. Here's the bad news. That's a 0% credit card that interest will be 30 or 40% on 250,000 when you add them all together after you do the transfer fees, because you can't buy a car on a credit card. So you got to actually liquidate it for 3 to 4%. Then that $300 to $400 a month you're making on Toro is not going to cover your minimum payments. And yes, people, you do have to pay the money back. So,
and I can't wait to see that luxury automobile that you're not able to rent out, and you want 100% depreciation on that thing too to come out the door, right?
I forgot about that. About
the $500,000 Lamborghini that you're you're being told that you can depreciate as soon as you take purchase or possession of it.
Can't do a 179 on a Lamborghini, people. That is the truth. Trust me, I tried.
Well,
I called Larry about that. He told me no way.
I'm going to say
Larry,
it depends.
thank you so much, everybody. That is a wrap. And those are the 5 financial blind spots you need to look out for if you're scaling. We'll catch you on the next episode.
Let's go.